This episode of The Officials was recorded at 12:30 p.m. BST on the 26th of September, 2024.
Hello, everyone. This is The Officials, back from Asia, live. Please hit the like button in your computer because we're going to have a very good show today. Two of us are just returning from Asia, and I'm showing this as evidence of having been there. I'll take it off now. We have been in China, in Singapore, and in Vietnam. And what we have to share with you is not a good picture. I personally didn't like what I saw. I saw an area in which cranes are missing in action. Those cranes were formerly everywhere, building housing everywhere, consuming iron ore, rebar, cement, just feedstocks to make housing, petrochemicals, everything. Now everything is shut down. The slowdown in China is extremely serious. And I don't think people in the West have fully absorbed the extent of the slowdown. And I think not even in Asia, because it's like things that are happening day to day and you don't see the change. I had the opportunity of being in Shanghai after not having been there for about 4.5 years. And what I saw is a city that hasn't changed much, which is strange for China, but it has changed in some respects. The noise in the streets is not about engines running about. It's about tires hitting the road, because about 70% or so of the cars on the road are EVs. And that's part of the change and what is affecting the oil industry. There's a real slowdown in industrial demand, and there's also a real slowdown in gasoline demand. We have some figures for you a little bit later, but I wanted to start with my colleague Harry, who was with me in Singapore, where we saw a little bit of a epiphany, I would say. What would be your view, your take of what happened in Singapore?
I think you laid it out very clearly, and it's true that during the conversations that you and I had when we were at the APEC conference, there was a sudden realization that, at least in the case of China, its larger cities, its coastal, especially its coastal cities, that there is something happening in terms of gasoline demand, and that something is highly related to the share of EV sales and the number of EVs that are actually on the road. And so from gasoline demand growth, people suddenly are having this revelation that, well, actually, maybe that growth is going to be non-existent in the years to come, because we've now passed a certain threshold and we may be looking at gasoline in the rearview mirror from a growth engine perspective for oil demand. So that is certainly a realization that led to a lot of the doom and gloom when it came to China's overall oil demand, because you end up with just a couple of supporting components such as jet fuel or feedstocks to petrochemicals.
Yeah. And while we were there, essentially the price went and it went even briefly below 69. I mean, it was kind of scary.
Yeah, that was right in the middle of the conference. Now, of course, you know how it is. The difficulty is when you have a market that is already extremely short, you ask yourself the question, how much shorter can it get? And if you have the sort of realization that the underlying fundamentals are not nearly as strong as you thought they were, even if you had a more conservative view, I mean, you know, at the margin, it's like, if I take off gasoline demand growth from China, if I modify this, I still have supply growth in certain key non-OPEC countries like Guyana, the US, you know, Brazil, Norway. Then the situation for the fourth quarter is suggesting the possibility of, you know, a surplus developing, irrespective of OPEC's efforts to try to manage supply in terms of the broader OPEC plus group.
Yeah, but markets are very interesting because even though everything was so bearish, And really any signal we get from the macro world in Germany, in China, in Vietnam, one key takeaway for me there was that cement exports from Vietnam to China had dropped by 90%. And the cement manufacturers were freaking out, obviously, right? But even though everything is still macro very negative, and this was the case while we were in APEC, suddenly there was a reversal. And a friend of mine, a banker as it happens, said, Jorge, we're getting to a dangerous level now, meaning too low, because the hedgers are coming in. He had received calls from airlines that had never called in a number of years from Japan and other places to say, let me lock in a little bit right now so that I can go away for this quarter with a little bit of extra money. And some shippers were also doing that. So when that hedging buying comes in, it creates an impression of a recovery market. And it's not just an impression, it's a real surge in buying back, but it may not arrest the overall trend going down. And those are the things where even though markets have a direction, is never unidirectionally, and we are saying that very much. I'm going to go briefly to Ed. What are the latest figures in EV sales in China?
Well, in China in August, I believe EV sales reached almost 54% of total vehicle sales. So clearly they passed the halfway threshold for overall sales in China. So obviously we're going to see a much lesser demand for gasoline if that continues. And as you say, as your report from Shanghai indicates, most of the cars there are EVs, so they're just not going to need the gasoline that they once did.
Yeah. So what, and Harry, you follow fundamentally these things very closely. The expectation of gasoline in China is still of a demand growth overall, isn't it?
Certainly there will be growth in gasoline demand in 2024 in China. I think it's more the sort of the perspective for next year that's sort of being brought forward, as in we have a slowdown in the second half in terms of Chinese gasoline demand growth. Next year, what is the growth picture going to look like? Most people, at least in terms of consensus of consultants, international agencies, they're maybe looking for growth of 1 million barrels a day globally for oil demand next year. But if you start shaving off bits and pieces in China, which has always been the main contributor to global oil demand growth, then suddenly things start looking a little more gloomy. And you tend to then have a sudden focus, right, on this very important country and how many engines it has when it comes to growing its oil demand. So if we've lost diesel, fuel oil doesn't do much. We have jet to a certain extent, and that really depends on how much more international travel recovery we could have between China and the rest of the world. That's not evident. And you're left with petrochemicals. So of course, there are a lot of things that the petchem industry produces in terms of precursors for the development of EVs, for example. But the bottom line is even the petrochemical industry, which produces anything from plastics to wrappers, the demand on their products is going to be contingent on the health of the economy. And that health, as you know, is being questioned, right? So even petchems, how much feedstock are they going to ask, whether it be propane or naphtha? That's an important question. And more recently, as we've seen, the Chinese government is acknowledging, along with its central bank, that it needs to do something.
Yeah, we're going to get a little bit more into those details, but I wanted to share with the viewers here that there are so many numbers out there in terms of what demand and consumption is. And I was just talking to a banker right now, and he said, we're always wrong. And when we get it right, it's due to randomness. And really, this year, it seems like that nobody knows what is going on. For what is worth, our view in situ, and we travel quite a bit, is I think gasoline demand will not be what all the consultants are saying, because economic activity is declining and EVs are chewing up demand and consumption, and therefore we could even see a contraction. But we are, as the officials, among the most bearish group you can find. And we read, of course, what other consultants say. And I was reading essentially an update by EA, Energy Aspects, where one of the consultants said we're past the worst. Well, there was even a worse after these words were being said. And talking to some traders, also seems like the market wants to trade with something starting with a 6. I mean, nobody knows the future, but it almost seems that the market wants to test those levels. And Will, which forecast can you trust then?
Well, it's a very good question. I mean, everyone likes to kind of throw their hat in the ring, I guess. And recently we got OPEC's long-term forecast. And they detailed demand growth at around 2.3 million barrels per day in that forecast, which is more than double what the likes of IEA have been projecting. And they're still pinning, 700,000 barrels per day of that on China. So there's been a massive divergence in what forecasters are projecting for oil demand growth globally for 2024 even as we're getting towards the end of the year. There's not many months left in the year to realise this huge demand growth.
There's nothing left. We have traded forward already.
Exactly.
Through the end of the year. But I wanted to needle you a little bit because you were looking at the figures and you told us that OPEC has one number in one publication and another number in another publication. So how's that?
Yeah, so we identified a small discrepancy, maybe not so small actually, between between the monthly forecast that they produce and their longer term outlook.
So what is the difference?
So the longer term outlook, as I explained, 2.3 million barrels per day, but their short term September monthly update was 2.03 million barrels per day. So
almost 300,000 barrels a day discrepancy within the same house.
Exactly. So we don't know if they forgot.
Don't be surprised if sometimes Harry says one thing and I say another. We're also the same, but we're separate, even though we're in the same house. Maybe OPEC is the same. Now,
exactly.
Back to you, Harry. What happened with the FT today?
Very interesting, Jorge, because it seems that was the talk of the town. The Financial Times had this very bold headline indicating that Saudi Arabia had somewhat or abandoned a price target of $100 per barrel. So the FT's article, of course, did the rounds, and the article itself was hinting at Saudi Arabia possibly reinstating supply. At the end of the day, this was a very smoke and mirrors type article because a lot of hoopla for nothing. Clearly, when you're at $70 per barrel, $100 per barrel target is in your rearview mirror. It's been months. Assuming that Saudi Arabia has even an unofficial target is a big leap. In all my years covering the oil market, Saudi Arabia or OPEC has never precisely targeted a price level that it would deem as the correct or fundamental or fair value. The target is a moving target. As long as prices go up and the world economy could sustain it, the higher the price, well, that's a price that they'll go with. So the hinting of Saudi Arabia abandoning a target and eventually reinstating supply, when you think about it, OPEC Plus has already come out and said they would reinstate supply if market conditions allow for it. And so they haven't allowed for it, which is a delay to the return of OPEC and Saudi production to the market to December. They will advise again in December. And when we think about the actual amounts involved, right, that will return, if they return, they're very small on a monthly basis. So at the end of the day, it would take an entire year up till the end of 2025 for Saudi Arabia to return its extra voluntary cut of 1 million barrels a day.
Or they could do it faster. I had a theory, actually.
They could,
but I had a theory. Saudi Arabia, budget-wise, ran out of money. And in order to keep things running, and they do waste a lot of money, I advise every watcher to read about the clock tower they built for $16 billion. But they do need to raise a lot of money. When they raise a lot of money and they recently entered the credit market, you need to justify to the bankers how you're going to pay back, how you're going to generate the cash. It will surprise me that in those conversations, some Saudi official told a bank, and I'm here, guys, I'm speculating, saying, oh, we can always increase production to pay back. And entities like the FT, a lot of us have contacts with banks, and these things, go through the ether, and suddenly we form another view about the market, right?
But none of this was in the article. I think it was just very cheeky of the FT to put that headline, because it actually has no idea whether there's an official or unofficial price target. It opens up, however, as an interesting question. So we have to, give back to Caesar what belongs to Caesar. Is at the end of the day, we are talking about the return of supply by OPEC. And at least the way we view it, right?
On a macro demand that is suffering very badly.
Exactly. So when we look at the balances, when you take out OPEC and you look at how much is supply growing, how much is demand growing, there is no room for OPEC's extra barrels. If they do put them on, then the likelihood is that we will have price weakness. The only saving grace for OPEC right now is if they ever decide to put barrels back on the market, whether you look at global onshore crude stocks as measured by, satellite services like the likes of Keros, for example, or even simply look at the OECD's data for crude oil held in industry storage for its member countries, the levels are low. So the one saving grace for OPEC may be that low crude stocks could help them add a little bit more oil. Yeah. But that's, at the end of the day, you do the barrel arithmetic, no matter how right or wrong, it just looks like there's no room for their barrels.
Yeah. So one of the conclusions I was running around with some of the folks is if OPEC puts more oil onto the market, and it looks like they're doing that, right? Because some of the allocations have already gone up, is that the oil has to buy its way in through price, which has to be lower than what it is right now, and create contango. So there is an incentive for the barrel to be put away. With those thoughts, however, which are very bearish and negative, I wanted to turn to Ed, who tends to be the sunny disposition within the group, to tell us what is happening in general, because there are many other things that are positive. Share them with us.
Yeah, well, one of the things I've noticed that is perhaps a positive step, or at least a baby step forwards, is the US response to Fed rate cuts. Because last week we saw that mortgage applications in the US increased by 11% week on week. So although most of that was refinancing, there were a 20% increase in refinancing in that week. That will still see some more money come into circulation in the US economy because people are spending less on their mortgage, means they can go out and spend it more elsewhere. They can go out to the restaurant and buy some food. They can go and buy some new chairs for the garden, whatever they want. And eventually that will translate into an increasing level of activity. People will drive to the restaurant, they'll drive to the garden center to get their new chairs. So that could eventually work its way into the oil demand figures, but that's still very much early days for this. So I don't think we'll see anything until like Q1, Q2 next year, really.
Yeah, the other positive, of course, the mega positive is the changes by the Chinese government, and they are massive. So stocks in China have gone up roughly between 10 and 14%, and also in Hong Kong, which is now part of China. So everything is going up there. And one of the things that one of the traders was alerting me of today is that iron ore has gone up by 10%, and so has the price of rebar. And that starts to sound a little bit like the real economy is responding. The trader wasn't long-term bullish because he thinks there will be another downward correction, but we see some of those green shoots working. In sharing our internal thoughts, we are bearish Q4. I think everything is going to disappoint in terms of growth, that all the economists haven't really factored in how badly the situation is, but that there could be some revival in Q1 or Q2 if there are additional measures on interest rates.
If I may, I mean, price reaction in iron ore or rebar or steel, etc., is to a headline. You know, I mean, well, you know, they announced easing policy just this week, so it's not going to be an instantaneous translation between an announcement and suddenly real activity. What does benefit in terms of immediate reaction are the financial markets. In my view, what China has done is going to benefit more the financial sphere than it is the real sphere. And this I've been talking a lot with Will. When it comes to monetary policy and its efficacy in stimulating growth, it's one thing lowering the cost of money, right, Will? It's another thing to actually have demand for credit, because without the demand for credit, then we don't get that monetary expansion, right?
Exactly. And in China, you have broadly what I would describe pretty risk-averse population. They like, historically they invest in housing, and recently long-term CGBs have been very popular among the Chinese investor.
In that one, I would disagree. I have lived there. They love to have a gamble.
Sure.
I mean, that's.
But not.
I
that's
hate to classify a population.
Jorge, that's at the casino, right?
I'm so sorry for doing that. But they like risk. They do like risk.
But where's that risk expressed?
But to be very serious here, one of the things coming in, and we are just hearing this morning, is that there are going to be serious fiscal measures by the Chinese government. That's imminent. I think the new fiscal measures will be released by tomorrow, and that means that China is really firing several bazookas at once at this problem, where they're trying to stimulate demand, real consumption, and move forward to the economy. They need to do that. And before we run out of time, I wanted to tell you that you need to go a little bit musical here. Please try to find out This Is the End by The Doors, and we'll give you some of the lyrics in the podcast. But listen to that and think about where we are going in Q4. This is The Officials. Please like and subscribe our podcast. You will continue to enjoy them. Thank you very much.